Hello and Assalamualaikum. I am Umaira Patricia and my teammates Karnisa, Nur Arifa, Karuhami Alfa, and Nurin Idina will discuss the topic of environmental management accounting and climate change. Without further ado, I will introduce the definitions of these two topics first. Environmental management accounting, which is EMA, is the generation and analysis of both financial and non-financial information in order to support internal environmental management processes. It is complementary to the conventional financial management accounting approach with the aim to develop appropriate mechanisms that assist in the identifications and allocations of environment-related costs. The major area for the application for EMA are product pricing, budgeting, investment appraisal, calculating costs, and saving of environmental project or setting quantified performance targets. EMA is as wide-ranging in its scope, technique, and focus as normal management accounting. Bureau et al. Stated there is still no precision in the terminology associated with EMA. They viewed it as being an application of conventional accounting that is concerned with the environmentally induced impact of companies measured in monetary units and company-related impacts on environmental system expressed in physical units. EMA can be viewed as part of the environmental accounting framework and is defined as using monetary and physical information for internal management use. Now let's move to the next part, climate change. Climate change poses a major risk to the global economy. To avoid dangerous level of climate change would be to take immediate actions aimed at mitigations and substantially reducing greenhouse gas emissions. Managing and mitigating climate change must be embedded in decision making. When it comes to capital expenditure and investment decisions, it is vital to apply the principle of sustainable procurement and consider long-term implications that affect the financial, environmental, and social rather than just short-term costs. I will now pass to Nurin Idina to discuss the details of EMA and climate change.
Hello, I am Nurin Erdina and I will continue our presentation with the types of environmental management accounting. In short, EMA. There are two types of environmental management accounting, namely physical and monetary EMA. Monetary EMA focuses on environmental aspects of corporate activities expressed in monetary units, such as measures expressed in expenditure on cleaner production, cost of fines for breaking environmental laws, investment in capital projects that improve the environment, and monetary values of environmental assets. Meanwhile, physical EMA refers to a company's impact on the natural environment expressed in terms of physical units such as kilograms or joules. For example, kilograms of material per customer served, joules of energy used per unit product. Monetary EMA seems to be about the impact about the environment on the firm's financial performance, and physical EMA is about direct effects on the environment. Next, we will look at the types of environmental costs, which can be categorized as follows. The first one, environmental prevention costs, the cost of activities undertaken to prevent the production of waste. Secondly, environmental detection costs, costs incurred to ensure that the organization complies with the regulations and voluntary standards. Thirdly, environmental internal failure costs, costs incurred from performing activities that have produced contaminants and waste that have not been discharged into the environment. And fourthly, environmental external failure costs, costs incurred on activities performed after discharging waste into the environment. Now we will see the effects of climate change. This includes hotter temperatures, more severe storms, increased drought, warming rising ocean, loss of species, not enough food, more health risks, and poverty. Further, how exactly does environmental management accounting relates to climate change? Businesses have become increasingly aware of the environmental implications of their operations, products, and services. Environmental risks cannot be ignored. They are now as much a part of running a successful business as product design, marketing, and sound financial management. As a result of climate change, certain businesses, especially those operating in highly industrialized sectors such as oil extraction, are facing huge increases in the costs associated with their environmental impact. These expenses may sometimes amount to more than 20% of total operating costs in certain circumstances. Such significant costs need to be managed. Poor environmental behavior may have a real adverse impact on the business and its finances. Punishment includes fines, increased liability to environmental taxes, loss in value of land, destruction of brand values, loss of sales, customer boycotts, inability to secure finance, loss of insurance cover, contingent liabilities, lawsuits, and damage to corporate image. Nearly all aspects of business are affected by environmental pressures, including accounting. From an accounting perspective, the initial pressures were felt in external reporting, including environmental disclosures in financial reports and the production of separate environmental accounts. Much has been written about the nature and quality of these accounts. However, environmental issues cannot be dealt with solely through external reporting. Environmental issues need to be managed before they can be reported on, and this requires changes to management accounting systems. Next, there are some benefits of environmental management accounting which I would like to highlight on. Firstly, improving sales or reducing sales erosion. Consumer awareness of products and services and environmental impact is increasingly influencing their preferences and buying behaviors. Secondly, reducing costs. Reducing wasteful consumption of input resources has a direct positive impact on reducing costs. Also, improvements to processes can bear down on costs. Thirdly, reducing the cost of failure. Investing in processes that reduce the likelihood and cost impact of failure, such as the need to process waste or clean up environmental impacts. And last but not least, improving the image of the organization. This can enable it to attract better talent, reduce talent attrition, and charge higher prices. Now, I would like to pass the floor to Arifah to proceed with our presentation.
Thank you, Hamid Alfa. So I am Nur Arifah. I will explain about the guideline for environmental management accounting. So EME guideline document have already been released by a number of organizations. Environmental costing for financial accounting and reporting, as well as national accounting and reporting, are also covered in details. Several environmental accounting books have also been released. All of these have considerably aid in the learning and application of EMA. The existing guidance document on EMA mostly have focused on three, which is the first one is guidance for different national audience, supplemented by national case study and pilot projects. Example for Argentina, Australia, Austria, Canada, and extra. So the second one is specific environmental management initiative supported by EMA, such as solid waste management via supply chain management. So the third one is different level of emphasis on particular EMA methodologies or approaches. So as we can see, it makes sense that different countries and organizations would adapt EMA concept, language and practices to fit their own objective, because EMA is still relatively a new and evolving field in comparison to traditional management accounting. Some experimentation and variety is to be expected. However, the large number of extant guidance publication has contributed to a lack of clarity regarding the precise definition, benefit and uses of EMA, as well as the various EMA methodologies and tools. The fact that EMA data is important for so many different sorts of management, decision and operations. With this in mind, the International Federation of Accountants, which is IFAC, Board of Directors agreed to commission this EMA advice document in order to compile some of the finest available EMA information and to update and add to it as needed. The purpose is to help clear up any worldwide misunderstanding about this vital topic and provide some practical basic information to individuals and organizations interested in learning more about EMA. Next, I will explain about Act and Regulations. So, this Act and Regulation refer to ISO 14031. So, there is three types of environmental performance indicator can be found. Firstly, operational performance indicator. Second, management performance indicator. And the third one is environmental condition indicator. These three are differentiated based on whether they are used to assess environmental aspect of company activity using input or output, material flow, balance, environmental management activity, or the state of the environment outside the company, which serve as a useful tool for establish an indicator system. So environmental performance indicators, which is EPIs, are defined as follows in ISO 14031. So OPI, which is operational performance indicator that provide information about the environmental performance of an organization operations. Operational performance indicators are suggested for all businesses and serve as the foundation for evaluating environmental factor, consumption of material, energy and water, as well as waste and emission in total and in relation to production level. OPI are a critical foundation for internal and external environmental data transmission, such as in environmental statement in line with the EU MAS regulation or in employee information publication. So the second one is management performance indicator, which is MPI, that provide information about the management effort to influence an organization's environmental performance. Indirectly, management performance indicator measure a company environmental protection activity and the result obtained in terms of impacting its environmental characteristic. They provide useful data, but not on the real external or internal environmental impact. They provide controlling with internal measurable data on environmental management operation, but no information on environmental performance or consequences. Environmental condition indicator, which is ACI, specific expression that provide information about local, regional, national or global condition of the environment. The quality of the environment is directly measured by environmental condition indicator. They are used to determine how air emission affect air or water quality. Government agency often monitor the environmental conditions surrounding a corporation. ISO 14031 further specify how indicator can be used to transmit information. EPI can be weighted or aggregate depending on the nature of the data and its intents purpose. To ensure verifiability, uniformity, comparability and understandability, aggregation should be done with caution. Thank you, that's all from me.
Thank you, Arifah, for the impactful explanation just now. Hello, hi, my name is Carol Hamia Alfa binti Kuridin, and with that, let's proceed with the risk businesses need to identify in relations to environment management accounting, EMA, and also climate change, CC. Proceed from that, the most significant problems of EMA lies in the absence of a clear definitions of environmental costs. This means it is likely that organizations are not monitoring and reporting such costs. The increase in environmental costs is likely to continue, which will result in the increased information needs of managers and also provide the stimulus for the agreements of a clear definitions. If a general applicable meaning of environmental cost is established, the use of EMA will probably increase with positive effects for both organizations and the environment in which they operate. In the future, it will not only be large companies which can afford to implement EMA, but also to the small and medium enterprises which have fewer available financial resources. Before I dive into detail, let's get to know what is actually Xerox. So, Xerox Limited is a subsidiary of Xerox Corporation which introduced the concept of life cycle costings for its logistic chains. So Xerox actually lost the original cost and had to bear the cost of disposal of the packaging. The core business of Xerox Limited is actually manufacturing photocopiers, which are leased rather than sold. So this means the machines are returned to Xerox Limited at the end of their lease. Previously, machines were shipped in the range of the different types of packaging, which could rarely be reused by customers to return the old copies. So the customer had to dispose of the original packaging and to provide new packaging to return the machine at the end of its leases. So its intents could not be used to reship other machines. So a new system was invented which used a standard pack tote. Two types of totes were introduced to suit the entire range of products sold by Xerox. So actually, totes can be used for both new machine delivery and also return car cases. The whole chain cost analysis showed that the considerably lower cost of the tote system compared to the previously existing systems, and the supply chain become more visible. Okay, first let's take a look to the physical risks, which those immediate threats that come from the physical environment. Flooding, hurricanes, drought, wildfires, these are all symptoms of the climate crisis and can all cause physical damage to people, property and also transport links. So first, the agriculture sector is particularly exposed to the physical risk. Both flooding and drought can pose a risk to crops and livestock, as do extreme cold and extreme heat. The Australian Bureau of Agriculture and Resource Economics reported that more than $81 billion have been lost by farmers in the 20 years to 2019 as a result of the changing climate, largely from drought. Next, we proceed with transactional risks that come from the potential cost to the businesses with the introductions of policies, laws, and other regulation designed to address climate change. So first, we're going to take a look to the energy industry, which the one sector particularly open to the transactional risk. With the push for greener energy sources, governments are increasingly shifting to a reliance on renewable energy sources and also demanding net zero carbon emissions from energy producers. Last but not least, we have liability risk, which arise from the failure to mitigate, adapt to, disclose or comply with changes legal and regulatory expectations. So companies that pollute are obviously exposed to the potential litigations, but so are companies that fail to consider future climate change in their products and services. For instance, structural engineers or property developers that fail to consider increased intensity of rainfall in designs of drainage systems.
Thank you, Hami Alpha, for your great explanation. Now, I will present to you the company that support climate change and their relation in environmental management accounting. The company purpose is to make a sustainable living commonplace. They make a sustainable living plan to reduce the environmental impact through innovation, R&D expertise, and partnerships with suppliers. This is a holistic plan of actions, inclusive partnership with governments, suppliers, NGOs, and other stakeholders. They introduce a climate transition action plan to reduce the carbon intensity of their operations by developing products with a lower carbon footprint to achieve a net zero emissions across their value chain. A Unilever plant in Ontario, Canada has an ongoing campaign to improve energy efficiency to help manage rising and unpredictable energy prices. By 2003, the energy team had more obvious ways of reducing energy consumption, so they need to find a more innovative ways to meet the ongoing goal of 6% reductions per year. One of the solutions was to invest in new technology, which is a reverse osmosis system that will enable significant measurable improvements in the efficiency of the steam plant operations. In the first year of operation, Unilever calculated that the project would lead to net savings of $3,378,000 based on 2006 prices, even after accounting for the full cost of operating and maintaining the RO system. It is expected that the technology will pay for itself in less than 16 months. By converting to the RO system, the plant is consuming 13 million gallons less municipal water with an associated cost saving of $68,000 and 8% less natural gas saving of $299,000. The plant is also saving nearly $25,000 in boiler and softening chemicals, releasing 240,000 less pounds of chemicals into the sanitary sewer. There were also other benefits, such as savings in labor, storage costs, and less back-breaking work for employees. The project has led to the company reducing carbon dioxide emissions by 1.6 million tons, as well as cutting other greenhouse gases. This is the disclosure for your strategy that we get in the annual report. As you can see, they have listed all the Unilever operations and break down them into scope. The disclosure is very helpful for the company as the board takes overall accountability for the risks and opportunities. With the effects of climate change becoming increasingly pronounced, disclosure of climate risk is critical for businesses. Failure to make a disclosure can facilitate in a poor investment decisions, asset losses, and the continuation of trade practices that lead to climate change.
Thank you, Karunisa. Now to conclude our case study, the business nowadays experience rapid, increasingly diversified economic growth. This economic development was supported by considerable pressure on some natural resources in many sectors such as mining, forestry, and agriculture. The environmental policy has been strongly influenced by concerns of human health, and international trade causes the businesses to adopt the policy for their sustainability based on the four categories of environmental costs, which is prevention costs, detection costs, internal failure costs, and external failure costs, the company should spend their money on these costs in order to be eco-friendly organization. Therefore, it is important to the organization to take consideration on the environmental costs and its benefit in order to sustainable in their business as well as protect the environment. On that note, that is all from us. Thank you so much for your time.